A memorial lecture is conducted to honor the life and contributions of distinguished individuals, celebrating their enduring legacy and inspiring present and future generations to uphold the value they stood for. And today we have gathered here to refresh our memory for our late C.A.S. Vaidyanath Aiyar, former president of ICAI. Happy morning to one and all present here, and welcome to S. Vaidyanath Aiyar Memorial Lecture. As we are celebrating ICAI's 76 years of independence, integrity, and excellence, let's honor its past, engage with its present, and envision its future. My ICAI, my pride. Let us all rise for ICAI motto as a mark of respect to our mother institute.
Yaesha sutteshu jagrati Yaesha sutteshu jagrati Kamam 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 kamarsho Ursho nirvimanaha Ader shukram Brahma Tasmin lokaha shataha Sarve tadunatyadi kaschan Etadvaita
Thank you. Please be seated. May I now request the speaker for today, CA.V R Govindarajan sir, to come and occupy the dais, please. A brief about S. Vaidyanath Aiyar. S. Vaidyanath Aiyar, elected president of ICAI for the term 1957 to 59. He served on the ICAI Council from 1952 to 1959. His tenure as a president ended due to his passing in office in 1959. As ICAI president, he was among the early leaders of our institute, helping shape the professional practice and standards in the post-independence era of Indian chartered accountancy. He established Mrs. S. Vaidyanath Aiyar and Company Chartered Accountant Firm in 1934. He served as a member of the Finance Committee of the Planning Commission. He is also acted as an accounts advisor to the Bharat Sevak Samaj, an organization involved in nation building efforts. A brief about S. Vaidyanath Aiyar Memorial Fund. This fund is established to honor late C.A.S. Vaidyanath Aiyar, former president of ICAI. This fund supports annual awards for outstanding contributions in accountancy and allied fields, finance assistance to deserving article assistance, and funding of advanced research in accounting and auditing. For this memorial fund, membership is of two types: life members who can make a one-time contribution of ₹1,000 and ordinary members who can pay an annual subscription of any amount. We take this opportunity to request our members to contribute to this fund in large. S. Vaidyanath Aiyar, his legacy continues to be recognized by ICAI, its regional councils and its branches by conducting these type of memorial lectures and financial assistance through the memorial fund. This S. Vaidyanath Aiyar Memorial Lecture was delivered by eminent personalities. Some of them are Professor Louis Goldberg from University of Melbourne, Australia, Sri S. Narayana Swamy, former industrialist, Honorable Justice C.V R Krishna Aiyar, Supreme Court of India, Sri K. Parasaran, Attorney General of India, Sri Subramanian, former Governor of Maharashtra, Sri T. N. Seshan, Chief Election Commissioner of India, Sri D. R. Karthikeyan, Director, Human Rights Commission of India, Sri G. Gurumurthy, a renowned chartered accountant and an influential ideologue, Dr. Subramanian Swamy, former Union Minister of Commerce, Law and Justice, Nawab Muhammad Abdul Ali, His Highness the Prince of Harkad. And in that line, we have with us today CA.V R Govindarajan, who will guide us to grow wealth and career, fund management simplified. A small brief about today's speaker. CA.V R Govindarajan is a Chennai-based equity investment strategist with over 4 decades of experience in capital markets and financial services. He has held senior roles with Lovelock and Lewis, the Export Credit Guarantee Corporation, and CAF Limited, where he worked as vice president in merchant banking and capital markets. He later served as a whole-time director for a corporate member of the Madras Stock Exchange and was actively involved in major IPOs and public issues. In recent years, he has focused on developing advanced equity investment strategies and is now dedicated to training and mentoring aspiring investment professionals. Yeah, big round of applause once again for CA.V R Govindarajan. May I now request CA Lakshmi Narayanan to come forward and present a memento to our speaker, CA.V R Govindarajan. Over to Govindarajan, sir.
So what? Yeah. Good morning, gentlemen and ladies. It's my pleasure to come back to this building after 50 years. And I used to attend classes here. And in 1973, I graduated from our institute. And I was in service for some years in audit practice, not on my own, as a paid assistant of a multinational company. And then went into financial services. For a number of years, I was managing IPOs for Bombay-based companies. A number of good companies from Tamil Nadu, Karnataka, and Andhra Pradesh, I was lucky to manage. Then we went to the stock market when it was opened up for CAs, MBAs, and all that in 1987. Then 91, the regional stock exchanges were closed, and then NSE came. Then we migrated to that. Then the whole entire stock market infrastructure changed for the better. So we moved along, and then I was looking after an NSE company in Bombay and Chennai, they were doing a lot of institutional business. So we had exposure to LIC, GIC, and other big investment institutions. So from there we migrated to other financial services like, private equity and corporate funding, etc. Somewhere down the line, I took interest in doing research on the equity management. When I felt that everybody was having a lot of funds allocation for having their own research divisions, obviously we must also do something on that. So I tried to focus more on understanding the market psychology, which is, in my view, was the single X factor, which ultimately differentiates between a successful and not so successful fund manager. Coming here to the stock exchange, institute, I had already addressed members in Vijayawada and Bengaluru last month on the same topic, that is, the opportunities available for CA members and MBAs and young professionals in the area of fund management. I am of the opinion it's a ocean which nobody has understood that, and people are maybe interested in investing their money or even speculating or whatever. They are the CA members, young members, in my view, should consider this as a serious career option. Only at a younger age, say about 3-4 years from graduating, it is possible for you to look at it. Once you set your practice or once you are in big employment, it is very difficult for you to move away. So with that in view, I approached our institute, CA Institute branches all over South India, asking them for an opportunity to address members. So that's how I started. So here it is, it is not a scheduled lecture for me. It is a last minute arrangement. And so I believe that the audience, what I would be happy to address will be a slightly different orientation. Nevertheless, I believe that anybody who is pursuing this kind of this skill set training and all that must be more interested in looking at all other entry options. So we have a ready-made audience in them. So what is fund management I'm talking about, and the opportunity available, that after 1990, when the reform process started, the entire orientation to stock market investing completely changed with the advent of screen trading, scriptless trading, etc. And the total funds invested, just multifold jump it took place, and subsequently the mutual funds came. That did the magic where collection of funds from small investors ranging about 3 lakhs per portfolio, which was hitherto was invested in fixed deposits. Of course, it was not away from the property market, which involves larger outlay. But this is an asset class which is slowly graduating from mutual funds into PMS and high-ticket investments, etc. My idea is to advise CA members to look at the opportunity to manage funds of high net individuals, corporates, business houses, family offices, etc., where the funds corpus is very large, starting from 50 crores to 500 crores even. So a person who can show success, a track record, definitely will get more funds to manage. And obviously, an established fund manager, chartered accountant will earn 20 times more than what you would otherwise earn as an established practicing chartered accountant. That is the difference. That is the difference. It may be more. I am just making it very small. It's much more. So I thought, come and address the members and tell them I am available to have an orientation course, training program, stretched for an year or so, and then make them a complete fund manager, ready to manage funds. What I could not do because of various reasons, constraints, where I could not successfully manage funds because of my other priorities. It's a late stage change where I went into research and then strategization and all that. Now I thought what I could not achieve in a way, I would achieve through other members or other trainees who could come forward to understand the mechanics. Indeed, I am of the view that time will make people understand that what is this. This is an opportunity which we should engage, we should look at it seriously, get ourselves fully equipped, and then look at this as another area of practice. Initially, those who are already in practice or whatever, they could look at it as a side practice, and then once they are established, they can move. I don't have to tell you or elaborate from the institute viewpoint about professional ethics or whatever, that you know how to look at that viewpoint. Now, how you keep yourself is the second stage. First, I would like to tell something about the market to demystify it. The problem with most people, where you get publicity, where you get in TV that somebody committed suicide, all that kind of losses, it is essentially because of speculation. I have not come here to talk about speculation. We are talking about investments. The problem with most cases is a thin red line. So people have lost money in the market, about which we get wide bad publicity, is about speculation. Speculation essentially means you are doing something which beyond your means. Naturally, it puts pressure on yourself, and then you make mistakes and make more mistakes, and you make more mistakes. At the end, you borrow money, and then you have interest, you have deadlines, you have threats, and all that kind of stuff. So you go into a whirlpool. Investment, if you do methodically, you will never lose. That is 100% truth. That is, you will never lose. But there is a way to do it. You have to structure it in such a way you cannot lose. So it is like the olden days, you know that major surgeries were done. There were a high rate of failures were there. Slowly over a period of time, these failure rates have brought below a single digit. So that is the same way a good professional fund manager can give 100% successful results. The only difference is the returns may vary from say 15% to 40% or whatever it is. That depends on various factors. But the fear of losing money is not at all there. That is a misconception. That is the members should understand. This is a beautiful opportunity for us to look at it. That is a growing field. Today it is fertile. There is not much of competition, and that is the area what we have to train ourselves and then start practicing it. Now, how you look at it? Why I say that the future is good? Because a lot of good work has gone in the stock market the last 30 years, and screen trading, then demat accounts, and then linking of deliveries to the banks. Within 1 day, the clearing account takes place, money comes to you. Then IPOs also, it is all allotted in just 4 or 5 days. There is no waiting period. There is no loss of checks. So many things are there. The infrastructure has completely changed. That is a very, very difficult thing to achieve. We must accept that even the people who criticize the SEBI for the valuation side, which is slightly dicey, the infrastructure side, our infrastructure is on par with any Western country. It is outstanding. And even the software, the digitalization, everything is up to international standard. So we are all proud in the olden days, the outside market where we had to contend with scripts, we had to contend with forged certificate, we had to contend with forged signatures, and then the IPOs where the refunds will not come for 3 months, checks will be lost in transit, so many problems. So today, they are all the past. Now we are in a new world. It is a six-way and highway traffic. So one side, your organizational problems are completely solved. And when you do fund management for others, there is no back office work. The entire back office work is done by the stockbroker where the account is there. Then you have no responsibility for the funds because you don't mix the client's money with yours. The client's money is lying safely with the account where he opens a broking account, a demat account. So you can't even touch it. So you don't have to worry. Somebody in your office can embezzle that, or some fraud can take place. No chance. It is straight away an account between the client and the stockbroker. It is now, that KYC is so tough. They don't even accept drafts. No cash. Only check payments from a designated bank account. Only 1 or 2 accounts you can designate. Money traffic between that account to and fro. So many checks and balances have come that you are absolutely free to concentrate on your research and then give good returns to the client. So on the organizational side, you are extremely well placed today. So that is one aspect of it. What about the taxation angle for the investor? Why should the high net worth individual choose? High net worth individuals, by definition, I mean those people who have got cash about 25-30 crores, which means essentially they have their own property, they have investments in gold, they have investments in everything. They are higher level people. So they are already, most of them will be in business. So they have extra money, either out money is as a Hello. So basically, they are risk takers. They know what is business. They know how these things functions, they can discuss with you their risk perception, and so you can accordingly tailor-make the portfolio for their most important thing is the market affords a minimum 30 to 40% return for a good portfolio if you manage it properly. And the SEBI, which is the regulating authority for portfolio management and fund management, does not put any ceiling on the fees. It is bilateral. You can charge any fee you want, in any way you want, milestone payments, profit sharing or whatever, except the profit sharing should not be mentioned in the agreement, but in real terms it is profit sharing only. Why? So in fact, some people structure this as a partnership itself to avoid GST and also avail capital gains advantages. Otherwise, if you take it as a fee, you have to pay GST, it's a cost, and then the taxation will be on the slab rate basis, like say 25-30% marginal rate or whatever. So many advantages are there, and I believe young CAs must look at it very, very seriously. They should get properly trained and then confidently look at it, because India is growing. The government is interested in an orderly capital market. They are continuously supporting the market with very progressive views. The investment institutions are there to support the market. The mutual fund collections are so large, and so that any money withdrawal by foreign investment institutions does not affect our market. The stability is maintained. So we are in a cruising mode, and this is the time where members should look at it for another option, career option. That is my idea. Now, look at the fascinating career option in equity shares fund management. We will make you a top-class fund manager to manage equity investments in India, USA, and UK. Why I am talking about these three countries? The three countries speak English. The three countries have well-developed stock market. The infrastructure, the rules, regulation, everything is almost same. So I take these three, and in all these three places, Indians are there. Our own people are there. So we have a ready-made clientele base possible. Oh, sorry.
We can just this one.
On the chair, okay.
This one.
Okay. A million USD based career and a multi-million USD wealth accumulation opportunity. Build wealth for others, build income for you, build wealth for you. What I mean is, the amount you are likely to manage in is so large that as a proportion of mid-teens, the income which one accumulates in your own account, it itself creates a fund base for your own self. So, in reality in India, there have been any number of cases in Bombay, Ahmedabad, Pune, where the fund managers have stopped accepting others' money. They have started managing their own money. Some of them have started airlines. Some of them have started big construction companies. Some of them have constructed supermarkets, like that. You know the names. So, build wealth for others, build income for you, build wealth for you. Age is with you. Look at a 30, 40-year career ahead. You can train one of your children to step into your footsteps to continue with a legacy. So, this is about the opportunity. Stock market, what is it? Primary market and secondary market. Primary market talks about IPOs. Secondary market is the stock shared in the NSE and BSE. Helps capital formation to fund businesses, forming an asset class for channeling savings of people, catalyst for growth of GDP and employment. These are all self-explanatory. Why NRIs, HNIs, corporates prefer investments in stocks over fixed yield securities? Fixed yield securities like bank deposits, bonds give a poor yield and are not hedged against inflation. Government of India, RBI are policy driven to keep the deposit bond rates low to aid business, retail home loan borrowers. Prevailing tax rates exemptions are not attractive enough to invest in fixed yield securities. HNIs can expect a much higher return through stocks than FDs. Long-term capital gain provisions are attractive in the case of stock investment. These are the reasons why high net worth individuals and family offices and businesses prefer stocks over fixed yield securities. Next comes properties. Poor yearly returns, lower than even FD bond yields. Minimum 10 years holding is required to see reasonable capital appreciation. Administrative repair costs, high registration stamp duty on buyers, poor liquidity when compared to stocks, potential litigation with time. These are the reasons why, as I said earlier, the HNIs and others are already having their own properties and other asset classes. So this is the one where they want a higher yield. That is why they are coming for equity investments. So obviously they know what is the comparative difference between properties and stocks. But this is a general reason why some high net worth people prefer stocks over properties. Futures of a stock portfolio. Possible to acquire top quality stocks like TCS, Infosys, Axis Bank at 20 to 28% discount to the recent highs, whereas properties will not be available at deep discounts. A good property in T Nagar or Mylapore, anywhere, you may not be able to sell immediately, but it is not going to be available 10% lower next year. Impossible. It can slowly go up. But in any stock, you name it, all over the world, there's nothing called a stock which can only keep on going up. No. Every stock potentially has a chance to come down 20-25% for various reasons. Not necessarily something wrong with the company. No. It is the way the market operates. The stock portfolio can be constructed slowly over a period of time using price correction to bring down the cost of holding, which is not possible in the case of property. It's a one-shot payment. While exiting from the portfolio also, one can exit slowly in small quantities in order to get a better price mix in a racing market, which is not possible in the case of properties. Highly liquid, can be encashed very quickly, low cost of holding. The cost of holding in DMAT, in NSDL is nano compared to the value. Why HNI corporates need fund managers? They are busy with their existing business commitments, believe in successful professional managers with a track record. Many of them are not conversant with investment nuances. These are the reasons why they believe in professional managers. Our virtual one-to-one training and mentoring sessions are designed for all professionals desirous of making a career in fund management. For trainees who are residents in India, USA, UK, catering to investment management service by clients in their respective countries. The theory, practice, nuances and strategies are one and the same. Only certain regulatory guidelines and transaction rules differ from country to country. That is why I said members who start practicing this can cater to our Indian origin in USA, UK and Indian as well as India, and then through them to other people who are eligible to invest in India. Our services. Course objective is to create a fully equipped fund manager out of CAs, MBA, CMA, CS, Commerce graduates within 12 months and also handhold with them during their initial years of client management. The idea is, what I am talking is about what will otherwise take 5 to 6 years for you to get fully trained in fund management. This training program will make you fit within 12 months. Having said that, in the initial period, there will be some kind of a self-doubt will be there, whether I am capable of handling others' money, I may not responsible. Of course, you are responsible. The legal agreements you make may protect you, that is different, but you have responsibility. So you need somebody to handhold you, give you a backing and all. That is what we are there. Training period could be quickened depending upon the frequency of training sessions opted for by the trainee. It combines practical training of 70%, theoretical training about 30%, theoretical knowledge about 30%, and real world fund management experience. Now, essentially what it is about, deep dive in stock selection. First, you a list of what to buy. That comes by shortlisting stocks from a large horizon available, and then shortlist to a smaller quantity of good quality stocks. Then brick by brick portfolio construction. You don't just go and buy and just like that whatever you want. It has to be done with lot of patience. In fact, when you handle a client's money, first 3-4 months you may not make even a single purchase. Because there should not be any compulsion that I have got the money, I have to buy. No. The success of any good portfolio manager is more in the waiting than in committing the money. So, brick by brick portfolio construction slowly, methodically on a programmed basis. Constant effort to create a low base. That means you want to buy lower and lower and lower by adopting a strategy of investing and then bringing down the cost of the portfolio slowly. Based on a non-aggressive systematic investment approach. That means you should not act, you should react. It's like, going to the seas, stand on the seashores, you should allow the water to come and touch your shoes and say, come inside, come inside. You should not just rush into that, then you will be drowned. The same way in stock market, if you board a running train, it is a prescription for disaster. You should, in fact, I used to say jokingly, go to the central station, that's the starting point, half an hour before the train boards. Don't get in the train in Vijayawada. The train may go to Calcutta, but you don't know, in stock market terms, in Vijayawada, when you are brought into the train, there is no guarantee that the train will go to the next station properly. It may reverse also in stock market. So you must buy it. You must buy it at the lowest rate. That means the downside should be protected. That means the area where you have to do it. That is, you can do it by doing some technical analysis that will come later. Based on a non-aggressive systematic investment approach. Our methods are simple, conservative, time-tested, fail-safe, fully risk managed. Fund management simplified, nuances mastered. Our investment method can withstand unexpected market shocks and turbulence effortlessly and convert those adversities into opportunities. This is not my only. Every fund manager must be equipped in this area only, then will be a successful manager. Our strategies execution cannot and will not fail. Maximization of returns in a methodical way is our USP. What we mean by that maximization? Stock market is an ocean. The prices move according to the demand and supply, and the way the big market makers and the people who run the show run it. So we cannot change it, but it is possible for you to, within the borders of the top and bottom of the price movement in 52 weeks, it is possible for you to improve the returns for the fund portfolio by adopting certain leveraging, averaging techniques. These are all strategies which are all well taught. There's no secret about it. You have to learn it. How to use leveraging and averaging techniques. That is what we call maximization of returns in a methodical way. We will handhold you during the period of your initial years of client management. What we need from you is patience, self-belief, commitment and confidence. These are the attributes of a good fund manager. Without these basic 4 things, it is very difficult to survive in this field and show positive results. This talks about our training, complete coverage, A to Z of fund management, clear and simple, no jargons, no fancy jargons, mathematical equations, etc. Practical scenarios through live and model portfolio investments, career focus fully designed to build a sustainable, rewarding career in fund management, how to maximize return, time-tested methods and strategies that we have built mixing technical position of a stock, which has already been shortlisted on fundamental analysis basis with clever strategy developed by us. Why career in fund management? Growth potential, outstanding fee potential, low fund manager base, geographical flexibility, low overhead does not increase in proportion to the volume of AM. What I mean by the last one, which is very important, I'll come later. Growth potential. We are talking about the Indian stock market growth in the last 20 years, 2005 to 2020. See the growth. Almost 400% growth in most of the parameters. Market cap, 35 crores to 438 crores, that is highest, right? Nifty index, 5,500 to 25,000. Listed companies grown from 785 to 2,670. Number of demat accounts have grown from 50 million to 205 millions. Mutual fund holding value has grown from 15 lakh crores to 75 lakh crores. Equity mutual fund folios have grown multifold to 24.57 crore in the last 20 years. So this is a base on which we can grow much faster. Future possibilities. With our economy expanding, capital market participation also is rising rapidly, especially from middle and upper class investments, moving beyond fixed income securities. What has been achieved today will become strong base or platform on which future growth will become a certainty. Even moderate inflation can make fixed income securities less attractive, and with further tax incentives possible for equity as a class, which now witnesses only moderate taxation, can explode as an asset class to unexpected levels, as has happened in many developed economies. So we are talking about a picture where the potential what we are talking is much larger than what was in the last 20 years. If one looks from our growing population and the per capita growth possible in equity investment, the market capitalization of NSE can double every decade. Some people are talking about 7 years, it can double. I took it at 10 years, that is what was the last year. Outstanding fee potential. Normally, I said mid-10% is about 15 to 16% is the fee possible on a bilateral agreement between a client and the fund manager. Which means if you manage a 10 crore fund and at 30% return, it is 3 crores, and that 15% is 45 lakhs. This is achievable in about 18 months' time. Now, the larger the fund, the returns goes up, and the overheads comes down, because whether you manage a 10 crore fund or a 50 crore fund or 100 crore fund, the manpower requirement is the same. The overheads are the same. Whereas the net profitability jumps in geometrical proportion, not arithmetical proportion. And as I said earlier, the entire back office work is done by a stockbroker. They give you research support. You can subscribe to free research reports and paid research reports, which are not very expensive, so that you can take informed decisions. At present, there are at least 1,000 fund managers in Mumbai, Pune, Ahmedabad, Delhi, Hyderabad, Bangalore, earning 50 crores plus per annum, and have built net worth exceeding 500 crores wealth, built through fees and smart investments. These are all the practical data available. But most of us are not aware, because for two reasons: they don't publicize about it, and two, they are not expected to advertise, because the client's account secrecy is there, so the client do not like the names to be divulged. So the fund manager also keep a low profile. They do it in a very quiet way of soliciting business from unknown customers.
There is no one in Chennai, sir. The list in Chennai is
Pardon?
50 crore earning because
Yeah.
there is no one in Chennai.
50 crores?
Is there any person from Chennai studying?
Chennai?
You have not mentioned Chennai, you have mentioned Pune.
No, Chennai is not there. We don't have not that much a presence in Chennai. Hardly over 2-3 people are there.
After this session,
Geographic flexibility, international practice. As a professional fund manager, you could manage equity investment in all developed markets, particularly English-speaking markets like USA, Canada, UK, Australia. As the theory and practice followed, there is quite similar to the one followed in our market. In UK, ISA accounts investments in equity share attract tax-free status, and it is a very large unpenetrated market with huge growth possibilities. NRI, IPO, PIO investors residing in these Western countries will feel more comfortable dealing with their Indian brethren who can speak their language and understand their needs and aspirations better. That's usually that's not applicable here. Low overhead. The administrative overheads of your office will not go up in proportion to the funds managed or the number of accounts managed, as most of the back office work is attended by the brokerage firm which handles the client trading demat account. They provide all the relevant data in digital form. The subscription fees for research report is not very expensive, and brokerage houses where the client's accounts are maintained do extend research support services to the valued clients. Additional fee areas: property tax, tax filing, funds repatriation service to NRI client, tax efficient investment solution to NRIs, loan against property arrangement, fund management for NRIs in their own country of residence. These are the other incidental practices available avenues for the earn while you learn. Trainees often ask whether they could. This is what the feedback I got in Bengaluru, where I addressed students also. After the meeting is over, or during the meeting also, they were asking about this. We have some people, can we start it? How can we go about all that? So trainees often ask whether they could earn while they learn. Yes, we could do that. We can do that. You can confidently make a pitch for managing money of your connections or offer that come your way on its own. You can bank on us to enable you deliver successful returns, as our strategy methods are fail-safe when followed completely without messing with it in any manner. Mastering market mechanism. This is the this from here it talks about the actual fund management exercise. Market forgives past dismal track record of companies if their corporate governance record is good. If suppose a company has a bad track record, it does not mean the stock will be ignored in the market. If the management has been good, they have not done any fraud in tax compliance or diverted funds and all that, they have a decent image, market will forgive them and they will take into consideration the future of the changes in the mix, product mix or whatever thing, whether turnaround companies. There are many examples where past losing companies have become in the market, it has become hot favorites. Vice versa. Very great companies. Pardon?
What's the first point? Yes, but.
Yes, bank.
Can you lie at the yes bank? To the first point, you noted enough. Market will forgive.
Where I put?
First point is that enough.
Yes, not.
Explain.
Next one, huh?
Market forgive the past dismissal. That point. I need to read the point. Go.
I didn't put.
Sir,
Yes.
market will forgive you. Yes, market will forgive past dismissal track record of company if their corporate governance record is good. Can you liaise yes bank towards the point, sir? Yes bank.
Yes, bank.
SARS.
Yes, bank is a very good investment today.
Today.
Yeah, it's a good investment. You can buy confidently. Yeah.
Saying they complied with all the corporate norm without any deal.
No. See, when it was a private bank, they made some mistakes. That man has been punished. He is in the jail. Now it is run by State Bank and professionally run. All the banks are the shareholders. That family is no longer there.
Okay. Anyway, thank you.
So the entire management has been restructured. The ownership has changed,
But the fact is, okay, you simply said once they have good track record about corporate governance, the people will forgive the past
No.
wrong.
In the case of Yes Bank, the old management is not there. It is brand new now.
But the name is itself is sitting there, right?
That is
You
okay.
will buy the share purely based on the name, right?
No. Yeah, that is, no. You should not buy the stock on the name of the name. You should buy the stock where there is a business model, future profitability, and pardon?
Take your time. But fact is, now okay, people have yes bank on the negative list, right?
No, that is all changed, sir. Yes Bank today, the profile has changed, and a lot of research reports recommends to buy the share. I am of the view that share should be bought.
Difference between the fund managers and retail investors.
Yeah.
Are deployed and automatically it will drive the market. Yes Bank now present
No,
situation.
as a fund manager, first I should see whether I will put my money there. That is the first test. Only if I am convinced that I will take the risk on a particular stock or a particular bond or a particular deposit, it qualifies for investment somebody else. If I say it's somebody's money, I will put it. If it's my money, I won't put it. That is not correct.
So individuals will not have the access to the complete data. Sir, individuals will not be in a position to analyze entire the statistics of that company, corporate governance and transparency in their
Yeah, that also.
all those things are there. Whereas fund managers, they are with all professionals.
Yeah. Fund manager, when you handle large portfolio, the objective is different.
Different.
And then the way you look at it is also different. But ultimately, fundamental analysis is the same for anything, whether it's individual or, corporate or big one. It is the same.
Yes.
Market. What is this? See, people are of the opinion that the valuation of a stock, it depends not on what it is today. The market discounts the future. What is likely to be tomorrow? That is more important than what it is today. See, I will give, suppose you want to give 100 rupees for a stock, give 30% for the past, 50% for itself, 40% for today, and 30% for tomorrow. That is how the market always values. Give or take a few percentage here and there. Well, a glorious past does not mean anything. The future is unlikely will not be good, or vice versa. That is how the market, the valuation is like that. Whether you like it or not, that is how. I am of the opinion there are certain principles of valuation I don't agree, but market is too big. Who are we to question that? For example, different sectors are valued differently. Commodity stocks are valued very low valuation, or manufactured value-added stocks are given a higher valuation. Ferra companies are given a much higher valuation. Why? Ultimately, the purpose of any business is to do some business, put some money, their own equity, borrow some money, leverage it, do some business, earn profit, pay taxes, distribute dividend, and then the price is in the stock market, quotation is there, demand and supply. So the valuation is done on the earnings per share and how the market discounts that for future also. Some kind of difference is there on the corporate governance model. Also, valuation metrics may change company to company. But in the market, all over the world, different valuation metrics are there for different sectors. In India, public sector is valued differently than private sector generally. Even among banks, private sector banks are given higher premium, whereas public sector banks are not that. So then commodity stocks value differently, value-added stocks or manufacturing stocks are. B2B is valued differently, B2C is valued differently. B2C is given higher valuation, B2B is given lower valuation, whatever. So these are all metrics which are not accepted. So we cannot ask it why it is so. Point is ultimately the EPS is the same, the future visibility is the same. Track record. For example, Tata Steel and Tata Motors both belongs to Tatas. Tata Steel valuation is 50% of Tata Motors. Why? Because they say it's a commodity, it's a cycle. That is a manufactured product, end product. So it is not subject to cycles. So we give more valuation to that. Because other basics are the same. So you cannot compare apple and orange. That is how it is. He asked a specific question about that market forgives past dismal record if the corporate governance. He said corporate governance of Yes Bank was bad. How you can trust it? It's a relevant question. But today that board is not there. That management is not there.
But it's in the thought, right? Sorry. Fundamental difference. Yes Bank corporate governance was bad.
Yeah.
But what he says is good. When the performance of corporate governance is good, it is ridiculous. Okay, they failed because of in spite of a good corporate governance. That's what he says.
But same bad opinion is still there. So that
That's what
market value is less than
That's the password, sir. They have changed the management, they have moved into different.
Simply we can't forget whatever happened in the past, right? Once you forget all the past, okay, then we can move on. But we can't, as a human being, you can't forget whatever happened in the previous days.
It's only the name, but people forget.
Thank you.
The name is different. That's what he says.
Good. Thank you.
Market ignores past successes if the present or future prospects are weak or when corporate governance falters. It is also a fact. Valuation is given by future prospects or challenges anchored on corporate governance. See, basically, the most important thing other than business model, profitability, all that, the management quality, that pedigree, that their standard is important. That is why, as a fund manager, we always latch on to good groups. I always prefer a government company because efficiency may be questionable, but corporate governance, there can't be any problem generally. Whereas a private company, a single man family company has the biggest problem because they will go into unrelated areas, they may diversify, they may pledge the shares. Market does not like if a promoter pledges his shares because if he doesn't pay the debt, the share will be hammered. So, these are the classifications that you have to make. So, generally, it will be on the safer side. You be with the established groups, with good corporate governance, good business model, good track record, or public sector. Public sector, the valuation is good also because you get it out lower prices than compared to private sector. There are minus point in public sector other than inefficiency. Sometimes, like banks, they merge inefficient companies to efficient companies. That is where that is one risk. But you can't go on wait for that. This may happen here. This may. For example, now banks are going to be merged. 4 banks are going to be merged with other public sector. Which are the banks which is listed and is going to be merged? That big bank is going to be affected in stock prices. But it is a question of short term, 1 or 2 years. Indian bank were merged with Allahabad Bank. At that time, the stock price crashed. But within just 2 years or 2.5 years, the price has gone 3 times more. So what was the opportunity with the investors should have, they were not happy with the capital bloating with Allahabad Bank and all that kind of thing. But a good bank is always a good bank. Valuation is given by future prospects or challenges anchored on corporate governance. That means corporate governance is a vital parameter for stock selection. That is the general consensus. Mastering market mechanism. Why analysis alone is not enough? Fundamental analysis determines what to buy. Technical determines when to buy or sell. Market behavior explains why and how prices move up or down. See, fundamental analysis and technical analysis are tools. They are the tools for that is developing the strategies. You put into practice. These tools are your assistants. But market behavior is an unexplained one. It's not a tool. It cannot be quantified. So you must master that. Then only you can be a successful fund manager. So we are trying. That is the title says, mastering market mechanism. That mechanism is nothing but behavior. We mean mechanism. What we mean is behavior is the one which is mechanism. We have to master the mechanism of behavior. Then that is the most important X factor for any fund manager, which is not taught in theory books. You have to learn it by years of experience. Mastering market mechanism. Next topic, who knows the market? Many people who are not conversant in the stock market does not know how the market moves. They are thinking that they are just like some buyers are there, some it's not so. Basically, institutional investors drive trends to a large extent on a long-term basis. They don't know the market. They invest either their own money or, if it is a case of mutual funds, others' money. They don't know the market. They don't move. Market makers, I don't know whether any of you are aware or many of maybe aware, I don't know. Market makers are the ones who take the risk in going close with the management of a particular stock, doing a lot of research, talking to the management, understanding the business, understanding what is going to be the future, and then they take bets on it. They are the people who move with the 18 months perspective. They are not interested in 5 years, 6 years, no, because they will move from one company to another. The market makers are what we call smart money, are the ones who move the markets on any given direction. Domestic and foreign institutional investors dominate ownership and give long-term direction. Market makers move daily volumes and price, and their flow decides short-term direction. That's the difference. Many of us People may not be aware of this phenomenon called market makers. We may also call them crudely operators, market operators. In worst terms, we may also call them as market mafia. Any names are synonymous. Ownership change and price change. Importance of holding pattern. If you go to any research, it will give you the holding pattern of any stock. How much promoters hold, how much foreign institutions hold, how much Indian institutions hold, how much the retail investors hold, totally how many shareholders are there, how much promoters equity is pledged. All the data is available. These are data which has to be looked at it from the market behavior perspective. Increasing institutional holdings is a positive. Price follows ownership change. Whenever the ownership change, significant change takes place, for the good or bad, the price also moves. Exit of smart money is a negative for short term. I am saying negative for short term. It is not for long term. There's still the quality of the company is there. It remains. On a short term, the price movement will be there because the people have made an exit with a large volumes. So, short term, there could be negative for the particular stock. Dynamic valuations. Valuations are not static. They depend on growth visibility, corporate governance, commodity or value added, state-owned or private, liquidity, sector leadership, B2B or B2C, foreign or domestic, holding pattern, liquidity, size of equity, face value. In fundamental analysis, there are two analyses are there. One is quantitative, another is qualitative. Right? Quantitative is nothing but going through the financial statements for the last 3 years, for profit loss account, balance sheet schedules, the ratio analysis, and then the quarterly auditor reports and all that. That is quantitative. The qualitative is understanding the management of that particular company, the capital structure, the face value, the floating stock, and then the management equity, all those, what I put there, list, liquidity, size of face value, holding pattern, these are very, very important before coming to a decision on to shortlist a company. These ones, all these things, this liquidity, size of equity, holding pattern, face value, B2B or B2C, foreign or domestic, commodity, all those things may not change every year. These are all more or less permanent. Once in a while, they may change to a newer product, inorganic growth or organic growth or whatever. Over? We'll rush through it because time constraint is there. Market is what? Market is nothing but accumulation and distribution. That is the market. If you sense what is that, you know what is investing. That from the technical data will tell you what is accumulation, technical data will tell you what is distribution. Which means there is something more than that which people may not understand is volume. The daily volumes of the stock is very, very important. That is, determines the liquidity. How much delivery takes place in a daily volume is very, very important. That talks about how much money people are putting to take delivery of the stock on a long-term or medium-term basis. So accumulation phase, when smart money enters slowly without noise, sideways price movement, low volumes to raise volumes, low delivery volumes, low public interest media coverage. When the price slow or dormant, there is no noise in the market, people accumulate it silently. When we sense it, all the media, all the things, they make a lot of noise and then they attract people attention and the retailers come and buy that. So that is what we say, low public interest in media coverage on accumulation stage, low volumes to raising volumes, low delivery volumes on accumulation stage. Distribution phase, where smart money exits slowly. Flat prices after sharp rise, high volumes daily, high delivery percentage, increase in speculative interest and media coverage. These are the distribution side where the price goes up and then retailers participate. Market corrections. Corrections are regular and usual. Corrections are required for a healthy market. To 25 to 40% fall and retracements are common, triggered by global events, policy changes, regulatory changes, shift in sentiments, etc. Corrections are big investors' entry opportunity. Bad news is, in fact, is good news. Corrections are an entry point for very shrewd investors. Fall and restatement, what falls eventually retraces and recovers. Quality stocks recover quickly. Quality stocks make even new highs. Volatility creates opportunity. Market is a big wheel, sector rotation. Some sectors will be at the top of the wheel. Some sectors at the bottom. Some at the midway, either ascending or descending. Market has its own preference which keeps changing. Previous year's fancy royally ignored this year. These are all, it regularly happens in the market. Contrarian thinking is you think differently from the majority, the herd mentality. Contrarian thinking, news as entry, exit signal. Bad news is a buy zone, creates entry opportunity. Good news is exit zone, signals profit booking. Retail investors are usually late decision makers. Media and market noise. Price moves first, news follows. That is the reality, what you are seeing. Media amplifies narratives. Media inspires news. They put the news in the feed. But news shows smart money's market position. Lack of news during accumulation phase, series of news flashes during distribution phase. Successful investors ignore market noise. These are all phenomena in the market. We try to master it. Investor psychology, buy high, sell low, react to market noise, lack of conviction and patience, fear and greed phenomena, confused between investing and speculating. These are all attributes for a normal investor. Mastering market mechanism, where returns are made, entry, exit zones. Bottom, declining sectors entry, top euphoric sectors exit. That is a repeat of the previous. Power of conviction. Conviction comes from process. Strong research builds confidence, right stock selection, correct entry levels, reasonable valuation, long-term view, pre-set return expectations, ignore short-term volatility. These are the attributes of a good investor. Patience is the key to success. Time creates wealth. Impatience destroys returns. Even test investors' patience. Patience is the backbone of investing. Compounding is time and patience. Compounding is a very pet theory where you wait for 10 years, 15 years with the stock, hoping that you will get multi-level, multi-percentage returns. Sometimes it happens, sometimes it does not. Nobody can predict whether it is a multi-bagger or normal returns. There are two different stocks. Same stocks are looking the same. One goes 10 times up, another does not go up 10 times, 15 times. They are not multi-baggers. You can never distinguish. There are, of course, some signs are there about market leadership, ownership, the group pedigree, etc., which can tell you some signs are there as a compounder. Otherwise, you must be happy with a reasonable return, which you set as a goal. Our approach to fund management process: correction, consolidation, retracement, new high. Proven approach: follow value and contrast cycle investing principles adapted suitably for Indian conditions. Stock selection: sector agnostic, bottom approach. We go reasonable valuation, most important. That is the topic is you can talk to players on the reasonable valuation alone, because that is the crux of the whole thing. What price you are going to give to a stock? It is all in your mind on demand and supply, which makes you change. That is reasonable valuation is you must decide for the sector how much you can pay, how much the discounting you will do. What is valuation is normally in market we talk in terms of PE ratio. PE ratio is a ratio between earnings per share and the price. Different stocks have got different PE ratio, ranging from 10 to say 60, 70 also there. Normally we consider anything between 20 and 40 are reasonable on a long-term basis. Quality focus: strong financial performance, robust business model, proven management track record, or the quality focus. High corporate governance standard, debt-free or low gearing, tight equity structure, strong ROE, consistent growth in revenue, EBITDA, PAT, and reasonable valuation again. Market entry, exit. Apply price time correction principle, simple technical analysis for entry, averaging, leveraging, exit parameters. Portfolio construction: maintain a non-aggressive systematic investment approach. Our approach, wait and react to the market invitations and developments and make measured moves. No panic reaction to market noises and vested investment recommendations. Have total faith, self-belief in and commitment to own strategies and methods. Patience is the key word. Fund management flow chart. I think this is summarizing the whole. Suppose you take some money, how you have to start, how you have to go through. That is what we are describing here. These are the three. I have no time. The time limit is there. Successful fund manager, strong in fundamental and technical analysis, strong research focus on macro analysis, market savvy, self-belief, faith in capital market system and government, commitment and optimism and patience. These are the attributes of a good fund manager. Then these are the topics where what we are going to teach. About 60, 70 topics are there. In the USA market, option segment is a big business, big investment opportunity, which there it is not available in India. We have only short-term options, which is nothing but speculation. Where the option market in US is different, where it is long-term, 1 year, 1.5, 2 years, where it becomes on par with the investment. There is a different market where. Maximization mantra, enlarging return ratio by 100% from what it is the USP. Proprietary strategy is not discussed herein. My name and whatever it is. My communication details. Thank you for listening to me patiently. Any questions are there, you can ask.
Actually, management of funds, like portfolio management, specific to particular organization or individuals can manage funds.
I can't. Yeah, tell me, sir.
Is there any regulation in CA.V for management of funds, portfolio management? They say specific minimum entry is 50 crores, 50 lakhs, I'm sorry.
You want to say about civil license?
Yeah. So,
Yeah.
Can an individual start managing somebody else's funds without...
50 lakhs is their minimum, they are saying.
Okay.
And for PMS,
Yeah.
those who have got a license, the minimum entry is 50 lakhs.
So-
You know why? That is wrong. Because SEBI sometimes it creates an entry barrier.
Exactly.
Why should they say 50 lakhs is the minimum? Why not 10 lakhs is small money? But they want to protect the big ones. So tomorrow they will make it 2 crores also. So that they will marginalize the small people who cannot get into that inside. But 50 lakhs is not a big one. That's today the market is like 50 lakhs is not. But the beginners are finding it difficult to restrict the minimum amount of portfolio managing is 50 lakhs.
Okay. So anybody can start with can accept money and start manage funds. Or
Legally, as per rule, you must go to SEBI, get a license.
Oh.
That is called PMS license is there. You must have an office, you must have some manpower, qualified people or something like that. You must have a minimum paid up capital of the company. It must be preferably LLP or a private company, not a sole proprietorship. There are lots of guidelines are there. You have to fulfill that. See, any profession, you have to have a regulator. And you have to go by the regulator's clearance. That cannot be, you have to go through that. Checks and balance, otherwise investors' money, where is the protection? Somewhere they will go if there is a problem, there is a dispute. They are going only to him, only to SEBI for arbitration or whatever dispute redressal mechanism or whatever.
Sir,
That is all. The 50 lakhs or 1 crore is not important. I am talking about big picture. About 25 crores, 50 crores, 100 crores management. Initially, you cross the boundary. First, see, the successful chartered account, practicing chartered accounts, how many years they have waited, how many years they have worked patiently, how many they have worked very hard until they reach the traction point. Here also do the same thing. Overnight, nothing comes. But I am of the opinion, and most of you will agree, once you cross the levels, the field potential is much larger than their practice.
I'll add to that, sir. Basically, there are various options. So for a PMS, it is 50 lakhs. for an RIA, Resident Investment Advisory, it is even 10 lakhs. There are various options.
Pardon, sir?
PMS. For PMS,
PMS, yeah? Hello.
for a PMS, it is 50 lakhs, no doubt. But there are other options like RIA, Well, there are various options. It depends on the value of the investment.
I am restricting my discussion only for PMS. Fund management only through equity. It's not about fixed yield. It is not about alternative asset management. It is not about private equity. I am restricting my recommendation to train fund managers in the equity managed shares listed in NSE and BSE. But because that is where I find opportunity. That is where I believe that the SEBI guidelines of no restriction on the fees, on the commission, etc., is very, very mouth-watering and interesting. Everywhere else they have put restrictions, not in this PMS.
Fair enough. But what I want to add is that there is another category of RIA, Resident Investment Advisory,
Maybe.
where the entry level is only 10 lakhs. It can still be done. See,
These are also procedural things. These are procedural things.
I'm just requesting you to share. Only thing is, all these have to be SEBI approved. As simple as that.
Yeah.
Whether it is RIA or PMS or alternative investment fund, I would request our members to focus only on SEBI
The most
registered fund.
successful ones in India have gone through only stocks listed in the NSE or BSE. That is where they have successfully made money. Other asset classes within the variation of liquid assets have come subsequently. In TVS, in Chennai TVS, Sundaram Trite and TVS, there is one, Mr. Gopal Srinivasan was one of the promoters of Sundaram Trite and TVS Motor. He runs a company with 1,500 crores of funds and management and alternative funds. And he is the president of the All India Association of Alternate Fund Managers.
Fair enough, Father, but this both RIA.
It is an association between Shriram Group and TVS Group.
I just want.
They don't invest in listed equity.
I just only want to add only one thing. RIA as well as PMS both invest in listed equities only. RIA, the portfolio size could be even 10 lakhs. In PMS, it could be 15 lakhs.
Yeah.
Thank you.
Sir, please. Sorry, echo is there. I'm not able to hear.
But ethics permit a member.
Huh?
Ethics.
PMS is allowed by ethics or not? That is the question.
What is that?
Is PMS allowed?
It's allowed by ethics or not?
Ethics
Portfolio
or not?
management services is allowed for CAs or not? That is the
For?
We had one hour.
Yes, started
We had 1 hour.
No. I will come to the later. If you are a practicing chartered accountant, you cannot do it. The institute does not allow you.
Nothing. It's all only for non-practicing chartered accountants only. 1 hour.
No, you have to restructure. I don't want to describe here the other ways available, you know better. But institute does not allow you. You are practicing as a auditor or a tax, whatever. You cannot involve in this activity. It's not allowed. In fact, 6-7 years before, I had a serious discussion with very large chartered accountants who wanted to bring their clients to me. But all of them could not structure a legal entity where they will get, because these are large amounts, the fee will be very large, running into crores. So they could not do justification because they have a practice. They cannot afford to leave it and come.
I think.
Thank you, sir.
Thank you very much, sir. I think we have a very interesting and interactive audience here, and I would like to inform the members that you can continue your discussions. Lunch is also to be served. Probably you can have enough time to have discussion with Govindarajan. Sir, thank you, sir, for accepting. And I think we will manage one more session also along with you for a really interested
It's my
and
pleasure.
specific audience. Yeah.
No, we need 6 hours to
Yes,
cover
that's
this.
right.
This is a very big topic.
Yes, sir.
Anyway, thank you.
Yeah, thank you, sir. Thank you, sir.